Welcome everybody to the Rainey review for June 2025. This slide shows the growth of $1 invested in various asset classes for the 3 months ended 30 June 2025. With one exception, this is a very good looking quarter. The leader over this 3 months is Australian shares in Australian gold, where $1 invested 3 months ago would have grown to $1.07. In second place is New Zealand property in All Blacks black, where $1 invested 3 months ago would also have grown to $1.07. Crowded in the middle is that 50-50 mix of shares and property and cash and fixed interest, where $1 invested 3 months ago would have grown to just under $1.03. The lone exception is global infrastructure in orange, which had a negative quarter. That aside, this is a very good start. This slide shows the growth of $1 invested in those same asset classes, this time over the 12 months ended 30 June 2025. The leader over 12 months, somewhat surprisingly, is global infrastructure in orange, where $1 invested 12 months ago would have grown to $1.26. In second place is unhedged international shares in navy, where $1 invested 12 months ago would have grown to $1.17. Again, middle of that unambiguously positive pack is that 50-50 mix of shares and property and cash and fixed interest, where $1 invested 12 months ago would have grown to $1.09. That's a better than average year. But I always say 1 year isn't long enough. We need at least 3 years' data. This slide shows the growth of $1 invested in those same asset classes now over the 3 years ended 30 June 2025. The leader over 3 years is unhedged international shares in navy, where $1 invested 3 years ago would have grown to $1.70. In second place in Australian gold is Australian shares, where $1 invested 3 years ago would have grown to $1.42. In third place is emerging markets in red, where $1 invested 3 years ago would have grown to $1.35. Again, standing out in the middle is that 50-50 mix of shares and property and cash and fixed interest, where $1 invested 3 years ago would have grown to $1.24. That's a good 3 years. During the quarter, we celebrated Matariki. In the spirit of Matariki being a time for reflection, celebration and preparation, I thought I would reflect on the first 6 months of the year, consider what we might have to celebrate as investors, and think about the lessons we might have learned to prepare for the future. Beginning with reflection, it has been a busy, we might say volatile 6 months. Markets peaked in February before a sell-off on concerns that the large spend on AI might be getting a bit ahead of itself. This was brought to a head by the emergence of Chinese AI technology DeepSeek. President Trump's so-called Liberation Day accelerated market falls as the world reacted to the new sheriff attempting to use a not very new tax strategy to get his way on all sorts of things. This extended to the president pressuring the US Federal Reserve by threatening to fire Jerome Powell as Federal Reserve Chair. Despite a lot of rhetoric and threats, the Russian war on Ukraine shows no concrete signs of abating, notwithstanding everyone's best hopes. Meanwhile, conflict in the Middle East escalated and spread, culminating in the US bombing nuclear enrichment facilities in Iran. This led to, ultimately unfulfilled, concerns about spiking oil prices. And finally, President Trump's big beautiful bill extending tax cuts, imposing spending cuts and raising the US debt ceiling resulted in a credit downgrade for the US. All of that doesn't seem like there's much to celebrate, and from a human perspective that may well be true. As an investor, things are quite different. At the end of that 6 months, notwithstanding all of that distressing news, where were markets? Up. By the end of April, markets had already begun recovering. By the end of June, markets hadn't just recovered, many around the world were at all-time highs. That certainly seems like something to celebrate, from the perspective of an investor at least. So, what lessons can we take from that 6 months to help us prepare for the rest of the year and, more importantly, longer? I think the retiring Wizard of Omaha, Warren Buffett, said it best when he said, "Successful investing takes time, discipline and patience." Markets are characterised by risk and uncertainty. That plays out in the form of volatility. Volatility is the price we pay to earn the expected return from markets, and we will earn it. as long as we are disciplined and patient. Thank you all for watching. I look forward to updating you again in the next edition of the Rainey Review.